Trade policy being another area that we try to stay in our lane, but I can certainly talk about it. But I have to say that at the start. Yes, it's so potential tariffs could increase prices, and then the question would be: is it just a price level increase, or does it actually stoke higher inflation? We don't see that in the data. It's really not in there. It's hard to find any imprint in the data. I gather you would probably have the same reaction, but you don't really see much in there, and it's probably early to be seeing effects from changes in trade policy. But in the first instance, though, a tariff would just increase prices rather than inflation itself.
So one of the favored indicators of, I think, all economists in this room is the shape of the yield curve. And we've certainly seen the yield curve start to flatten over the past year. And my question is, how do you think of the yield curve? How do you interpret the shape of the yield curve, and how it should or should not inform Fed policy?
You know, a downward sloping yield curve could mean that policy is currently tight, in the sense that the short-term rate is higher than the longer-run neutral rate. It might mean that. Or it might mean that term premiums are negative. Mm-hmm. But it is true that there's an empirical regularity between an inverted yield curve and a subsequent recession. But I sort of look at it as, going back to where I started, we know why short-term rates are going up. They're going up in part because it's meant to map our policy path out. A lot of things go into long-term rates, so they can be low for term premium reasons, they can be low for expectations reasons, and to the extent, if you can sort of pull out of them an estimate of the longer-run neutral rate, then you can ask yourself whether policy is tight. And even by those measures, policy is not tight at this moment. So I don't see that. And I would always say, too, that it's just one of many things we look at. We do look at it, we talk about it, you can tell from the minutes. But it's one of a range of factors that we're keeping our eyes on. So
just to sort of take a different perspective, and it's always, I'll put a plug in for the closing session that I'm on the panel for, which is what have we learned 10 years on from the financial crisis. But one of the things that I always think is interesting is what we learned 10 years ago is probably not going to be what we learn in the next 10 years. And one of the questions here is, what tools will the Fed likely use if headline inflation exceeds targets? So maybe a pretty standard answer, but curious if you have any thoughts on that.
So in other words, if inflation comes in above target, I mean, we would always, our first choice, I think, would always be to use the federal funds rate and work through interest rates. That's what we have experience with over decades and cycles, and that would be our first choice. If embedded in that is a question of would we start selling assets, the answer is no. Yeah. We're going to stick to our balance sheet reduction program because it's working very well, and I wouldn't want to send any signal that that we'll revisit that anytime soon.